and we'll get it I think by the end of this year, 2024. Originally, John Greenwood and I thought that you would get it earlier. We thought originally that it would be in 2023. It turns out we were wrong with that forecast. We adjusted.
Economist Steve Hanke returns to the show. He is the professor of applied economics at Johns Hopkins University, and we'll be discussing the latest economic data, including the latest jobs numbers and inflation, and what all this means for the future of the economy and markets. First, a word from our sponsor, iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1%, along with unique tax benefits. So if you're over 18 and you want to open a new account with cash or roll over an existing account, check out the link down below at itrust.capital/David to get started. Professor Hanke, welcome back to the show.
Great to be with you, David.
Good to see you on this Friday. Let's start by talking about the latest employment report that came out this morning. Your initial reaction to what was reported, certainly in the markets, took whatever was reported as good news. The S&P 500 is up 1%. The NASDAQ is up 1.6%. Gold is down 0.8% as we're speaking today, as of 2 p.m. Eastern time.
Well, first of all, the report was strong, more jobs than anticipated, much more than the consensus. So this is the second month in a row where the actual data have outperformed the consensus by a fairly wide margin. But you should note that these monthly figures are pretty volatile, a series, the jobs report. So that's one aspect, but the market reaction that you mentioned is a critical thing. And now the market has pushed off the potential rate increase, I should say rate decrease, the rate decrease that the Fed will put in place. They push that back into the May-June category. And also the market now is anticipating smaller reductions than they were just 24 hours ago. So the effect of the job market data being strong has led the market to believe that the rate cuts will be smaller and they'll come later rather than earlier. That's basically what's being priced in.
Yeah, CNN used the words "shockingly good jobs report." Would you say it was shockingly good? Were you shocked, Professor?
Well, I wasn't necessarily shocked because it was a good report, but I wasn't shocked because those series are quite volatile. They go up and down, up and down, up and down, and a lot of times the consensus just misses the mark on them, which they've done the last 2 months. The consensus is underestimated the jobs that were going to be created, and so that's where we're at now. The Fed, of course, the thing to me that's interesting, this simply means that the Fed will probably wait too long to pivot. And why I'm saying this is that the money supply is contracting now at an unprecedented rate, and the Fed should already be pivoting, because this contraction in the money supply not only, of course, is put the cap on inflation, and that story is history in my view, and it simply is going to lead to a slowdown eventually in the economy. These things are baked in the cake in the sense that a year and a half or 2 years ago, the slowdown in inflation and the economy were baked in the cake, because that's when the money supply started contracting.
Right.
You have a contraction in the money supply, and what happens? Well, you get a big, long variable lag of 6 to 18 months. Sometimes it can even run up to 2 years, 2.5 years, something like that, before you get a change in economic activity, but you'll get it eventually. and we'll get it I think by the end of this year, 2024. Originally, John Greenwood and I thought that you would get it earlier. We thought originally that it would be in 2023. It turns out we were wrong with that forecast. We adjusted because we kept looking at the data, and what was happening is that initially we had this explosion in the growth in the money supply. Remember, it was growing at one point at a peak of 27% year over year. That's way higher than Hanke's golden growth rate, consistent with the 2% inflation target. That's about 6%. The golden growth is about 6, went up to about 27. We got a lot of inflation, and as a result of that, the Fed starts pivoting and tightening and overdoing it, and contracting the money supply like we've never seen since the Great Depression era, 1929-33. And with a lag, we're going to get the recession. But why did Greenwood and I miss this thing the first time? Why did we think there was going to be a recession earlier rather than later? And the reason for that is that we had this big buildup in excess money, and John and I looked at the typical rate at which those excesses drain out of the system, and that looked like we'd be on the front end of the lag. And it turns out the drains were going more slowly than typical, and now they've just drained off, and we've subsequently, of course, changed our forecast to put us at the long end of the lag. Instead of seeing the recession start in 6 months, we're seeing it start in a year and a half or maybe 2 years. But that's the way these lags work. That's why they're tricky. To start predicting exactly what the timing is going to be is difficult. To predict what's going to happen is not that difficult.
So
In
just
other words,
yeah.
David, to predict the coming recession, it doesn't take a rocket scientist to look at this. We've had the money supply contracting by 4.5% since March of 2022. That's the biggest contraction since 1933. And what happened then? Well, we had a Great Depression. We had 3 other contractions in the history of the Fed, and those contractions always led to a recession. So we'll see a recession, but the timing of that has been pushed out, and the reason it's been pushed out, as I said, this massive excess quantity of money overhanging the system just wasn't draining out as fast as it typically does.
So it's not a guarantee that a recession will happen necessarily this year, maybe next year, right? Is that
well? I'm not guaranteeing anything in terms of timing. I'm just guaranteeing that it will happen, and it'll probably happen late this year. It could be early next year, but
okay.
That looks like where we're going with the timing on this thing, and we're more assured of this because this strong jobs report simply means that the Fed will be later and later to pivot and start loosening up.
On prior episodes, you have mentioned that most likely would happen this year. So you're pushing it back because of today's jobs report or other indicators?
No, we pushed it back a long time ago. We said
okay.
This year. We said this year it would happen late this year. That
right.
was our changed forecast.
Now
I'm simply saying it looks like, yeah, that's probably going to be more or less the case because the Fed will probably be a little slower to pivot, and they might not pivot quite as hard as many people thought, that the markets thought anyway, 24 hours ago.
Sure.
If you look at the market today versus where it was yesterday, the market is saying a deferred pivot and one that is not as sharp. That's what they're saying today versus yesterday. And that's all because of the strong jobs report. And the Fed watches this contemporaneous data. They're data driven. So they look at what's going on with the data today. That's why the jobs report today is significant. That's why it moved the markets.
Okay, inflation. We have to talk about inflation first before we finish off on some geopolitics. So, are you still sticking with your inflation forecast that it will average between 2 and 5%? Is that
Well, that was for the last year. It did. It ended at 3.4. The
now it's going to
forecast
go
for
down
the
to
end that was 2023. The for Greenwood and Hanke think that by the end of this year, 2024, the inflation will be at the 2% inflation target, or maybe even lower, 2% or lower. So that's why I say the inflation story, in a way, is kind of history, and it's history because what's happening to the course of inflation all this year has been predetermined by what was going on with the money supply a year and a half ago.
Are you surprised that the decrease in the money supply hasn't weakened the jobs market considerably yet? Is there no correlation whatsoever?
No, it's these lags are long and highly variable. So I'm not surprised, and I wasn't surprised by the data simply because the data series for jobs is highly variable. It zigs and zags all over the place, and the forecasters have trouble putting their finger on the thing month to month where it's going to be. I mean, the last 2 months they've been off. They've underestimated. The jobs reports have come in stronger than the consensus forecasters.
Let's take a look at what's going on in the Middle East. The U.S., as we're speaking today, has just approved a series of strikes on Iranian targets in Syria and Iraq following drone strikes by Iranian-backed groups on U.S. troops that killed 3 servicemen, as you know. So tensions are escalating in the Middle East. Does this have any market impact whatsoever? Are you following this?
Well, yeah, I mean, how can you not follow it? It's all over the news. So my point is the following: the propaganda narrative that's being spun out of the Grand Wurlitzer is what? That this thing is contained. The U.S. is threading a needle, keeping everything contained. This isn't a regional conflict, and everything's under control, basically. That's not true. My take since day one was that this thing was going to escalate and be a regional conflict, and continue to engage the United States more and more all the time. The United States is being sucked into this more and more all the time. And the latest episode was this incident where that drone strike hit that base out in the eastern part of Jordan, right on the border with Syria and Iraq, and of course we are being sucked into it. The drones hit us. You have to ask a question: why do we have all these bases all over the place? They're always pointing out the way the propaganda spins it in the United States is, well, all these bases are being struck in Iraq all the time, or in this case, we're talking about Jordan. My question is, the thing that's interesting is, boy, we've got a lot of bases and servicemen all over the place. And it looks like in this case, they were kind of sitting ducks.
Okay.
So at any rate, forget the threading the needle. Everything's contained. It's not a regional conflict. It is escalating. It is regional, and it has a tremendous amount of collateral damage and cost and danger associated with it. The more the U.S. is sucked into these things, the more dangerous it gets. You don't want to get the big boys firing at each other.
Iran has threatened to retaliate should the U.S. escalate this beyond what's already happened. My question is, Professor, do you think that ultimately there will be a hot war where the U.S. is engaged directly with Iran or its allies?
Well, I'm really not in the business of predicting which way a spinning coin is going to land, heads or tails. I think we just all I can observe and anticipate is more escalation, more regionalization. Forget the standard narrative that everything is under control. It's not under control.
Will this put a pause on Fed cuts this year?
We we really don't know.
Mm-hmm. Okay. Well,
I think the way to put that question would be, would this accelerate the cuts? Because if things get hotter and hotter and the U.S. gets more openly involved in things, that's a negative. That's a negative for economic activity. And if it's a negative for economic activity and the Fed is watching the current data on jobs and unemployment, economic activity and so forth, and if that gets weaker because of what's going on in the Middle East, for example, then the Fed would pivot more rapidly. We'd have just the opposite reaction we had today with the strong jobs report. That Middle East thing could slop into a negative on the jobs picture and economic picture. And if that was the case, of course, the Fed would be, people would be anticipating that the Fed would do something sooner rather than later.
mm-hmm. Okay. Perfect. Professor Hanke, thank you very much. We're going to do a regular bi-monthly, so twice a month updates with Professor Hanke. We skipped last week. I was out of studio, but we'll keep it more regular going forward. Thank you very much for your timely updates. We'll speak again soon. Where can we follow your work, Professor?
On Twitter is probably the easiest way, and that is at Steve_Hanke, and you'll see I'm up over 701,000 followers right now. So
Congratulations.
It was a little barrier, 700,000. You keep those kinds of numbers in your mind, but they can do that. Or if they want, they can just send me an email at hanke@jhu.edu, and I'll put you on my distribution list.
All right, we'll put those links in the description down below. Make sure to sign up to Professor Hanke's distribution list. Thank you very much. We'll speak again next time.
Thank you. Great to be with you, David.
Good to be with you again.
Okay.
Have a great
Thanks.
weekend.
Okay. Same to you.